Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. If you're in the market for a home, you probably don't have the cash to buy it outright, so this means you need to take out a mortgage. The two most common choices are a 15-year or a 30-year mortgage. So in this video, we're gonna dive into the details of both of these and which one makes the most sense for you. And we'll also take a look at real examples using my home affordability calculator. Stay tuned. Okay, so I'm gonna jump right into the basics. Some of you may already understand this, but for the people that are brand new to getting a mortgage, this is important. So in this column, we have the 15-year, in this column, we have the 30-year. So with the 15-year, you're gonna have higher monthly payments, you're gonna have lower interest on the loan because it's a shorter duration. It's 15 years versus 30. It's a shorter risk to the bank or less risk to the bank, so they can give you a better rate. And then you have smaller interest paid over the life of the loan because the percentage is the same, and you're also building equity a lot quicker. We're gonna look at an amortization table later in the video, and you'll see that with the 15-year mortgage, more of your payments are going towards the principal rather than just the interest. And then if we look at the 30-year, it's the exact opposite. It's lower monthly payments because it's stretched out over a longer period of time. It's a higher interest rate because, again, it's more risk to the bank. It's a longer duration. The bank has to be compensated for that risk in the form of a higher interest rate. More interest paid, not only because the interest rate is higher, but the loan is longer. And then it takes longer to build equity. This is because less of your payment is actually going towards equity in the beginning of the loan. Okay, so let's get into the math of the video. That's the whole reason why you're watching this in the first place. So at the time of this recording, the median price of a house in the United States is $420,000, give or take, okay? These are the actual interest rates at the time of this recording. For a 15-year, it's 6.1%. For a 30-year, it's 6.9%. Obviously, this has to do with how much money you're putting down and also what credit score you are, but I'm just assuming you're decent credit. So a down payment of 20%, not everyone's gonna have 20%, but for the sake of this video, we're gonna assume that you do. That way we don't have to calculate PMI, private mortgage insurance, and all that other stuff. So just for the very basics, let's assume you're putting down 20%. 20% of 420 is $84,000. Okay? So that means our loan amount is going to be 420,000 minus 84,000. That's what these numbers are based off of. And I'll show you screenshots of my calculator as I walk you through this. So with that being said, these mortgage payments are going to be $2,854 for the 15-year, and then it's going to be $2,213 for the 30-year. So right away you can see that there's a difference of about $640 in payment, but keep in mind this is 15 years less than the 30, okay? So here's where it gets interesting. So this column or this row right here is basically the amount of interest you're gonna pay over the life of the loan if you just paid your minimum payment, right? The principal, interest, all that good stuff. If you just stuck with the actual amortization schedule, 180 months, 360 months, this is the amount of interest you're gonna pay. So for the 15-year, it's going to be $177,638. Now for the 30-year, if you wanna pause the video and do the math yourself, let's see if you can come up with the answer down in the comments below. I'll give you a chance to pause the video. If not, the answer is $460,643, okay, for a total. Now, remember, this is the amount that you're paying for the house, okay? It's the difference, basically, between these two, and I'll show you. The total is the interest paid over the life of the loan, plus the amount of money that was loaned to you, if that makes sense. So the 15-year total cost is going to be $513,638. The 30-year is going to be $796,643. So this is a difference of $93,638. This is going to be a difference of $376,643. Okay, so now that we have these numbers in front of us, let me pause for the thumbnail of the video. Now that we have these numbers in front of us, you can see the massive difference. It's going to be $283,000, give or take, okay? So with that being said, what you need to realize is a few things that a lot of people don't talk about when they make these kinds of videos, okay? The cost or the worth of $1 today, this is called the time value of money, and you can do this with net present value calculations. $1 today is worth significantly more than $1 30 years from now, okay? Or even $1 15 years from now. The reason for that is because of inflation, okay? Your dollar today is not gonna buy the same amount of goods and services as it is in 30 years from now, okay? That's why we invest, to try and maintain our purchasing power. So with all these calculations being equal, what is a decent way to look at this without getting into super complicated calculations or having a crystal ball, because we don't have a crystal ball. So the M2 money supply growth, this is basically the money that's inside the system. You can look this up and figure out your own definitions and see if it applies. But in my opinion, the money introduced into the system is the classic definition of inflation, okay? More money in the system, your dollar is worth less, okay? So M2 money supply grew from January of 2000 to December of 2024 by 6.9%, okay? The S&P 500 from January 2000 to December 2024 was 6.63%. So that basically means your $1 in January of 2000 grew to $3.39 in 25 years. So your $1 turned into $3.39. Now, why am I bringing all this up? It's because these rates at this current moment are very similar to the amount of money growth and also to the return of the S&P 500 in those same years, okay? So you can do the calculation of like, okay, what if I put less money down and put it in the S&P 500? What if I went with the 30-year and I put this difference of 283,000 into the S&P 500, right? Instead of just, paying this thing off outright or, going with the 15 or paying this off in 5 years. So the funny thing is these are very similar rates of return. So you have to think about it this way, you guys. If you were to take out this 30-year loan and pay this thing off on day one, let's pretend you take out this loan and pay it off in a day, you're making a guaranteed tax-free rate of return of 6.9%. You're eliminating that risk. That's why it doesn't make sense to pay off a low interest rate mortgage. Say you have a 2.5% mortgage, right? It would make no sense to do that because we know that the S&P 500 returned 6.63% the last 25 years, and we know that money supply grew by 6.9% over the last 25 years. They're literally inflating your debt away as long as your wages keep up with inflation, right? So all that being said is that this is a fair example based on what the stock market has returned over the last 25 years and also what the inflation rate pretty much really is. We all know that the last 4 or 5 years it's been much higher than this. But I'm saying all that to say this is pretty much a fair example of, hey, if I pay this thing off, it's gonna be a guaranteed rate of return of 6.1%. If I pay this thing off, it's gonna be a guaranteed rate of return of 6.9%. The ultimate question is can I beat these numbers in the stock market or investing in something? In my buddy's lawn care service, right? I just made that up. So hopefully this provided some enlightenment when it comes to the numbers side of things. Let's get on to the pros and cons of each option. Okay, so very quickly, pros and cons. Some of these you're starting to understand, some are new. I just wanna go through this very quickly, and then we'll get into some alternative options to find the best of both worlds. And then we'll figure out which one finally is the best case. So for 15-year pros, you save more money because you're paying less interest over time. You build equity quicker and it's paid off faster. The cons are that you pay more per month in the payment and you have less flexibility in budgeting, okay? The 30-year is that you have increased cash flow because your payment is smaller. It's easier to qualify for a 30-year mortgage and you have the flexibility to invest. Remember, we made the difference of $1 today versus $1 tomorrow versus inflation over 30 years. Is it worth investing rather than paying off that mortgage, right? Again, it just depends on the interest rate. And then finally, the cons of the 30-year is that your interest is gonna be higher over the life of the loan in a nominal amount, not necessarily in an inflation-adjusted amount. and then it takes longer to build equity. So with all that being said, let's get into when to choose each type of mortgage. We'll go over different life scenarios, and then also we'll get into my thoughts at the end of the video. Stay tuned. Okay, so when are you choosing a 15 or a 30? And then we'll get into my thoughts to finish off the video. So if you have stable income, 15-year mortgage is probably for you. This shouldn't be for entrepreneurs, commission salespeople, people with small businesses, people that don't have a predictable income, right? That's why you want the flexibility of a 30. It's a smaller payment. You can always pay more to pay it off like a 15. If you want to save interest over time, again, this is debatable with the rate of inflation. It all just depends on the interest rate of the mortgage. And then can you afford the higher payments, the 15-year payment versus the 30-year payment? We saw a couple slides back that for the same amount of house or the same price of house, you're at $600, $700, $800 a month more per month, okay? Now with the 30-year, this is for people who want less dollars per month or a smaller payment per month. They want increased cash flow to be able to do other things with that cash flow. And this is typically for people who want to refi down the road. That's what a lot of people are doing now. They're getting into these houses at 5, 6, 7, 8%. If you look at the 10-year treasury, it's absolutely skyrocketing again because of inflation. But they're gonna say, hey, down the road, the Fed may cut rates, the 10-year treasury may go down, mortgage rates are gonna go down, I'm gonna then refi at that point, okay? That's always an option for you. Okay, so with my thoughts, just to wrap up the video, you can always do this. You can always pay extra on a 30-year mortgage to pay it off faster. You can do bi-weekly payments, or you can make extra principal payments. What a lot of people do is they take out a 30, they pay it off like a 15, or they just make an extra payment every year, and that'll significantly reduce the length of the mortgage, okay? You can also consider a 20-year mortgage as a middle ground option. So if you're someone who doesn't want to deal with making extra payments or doesn't know how to do that, you can always just take out a 20 and it's the best of both worlds. You'll get an interest rate somewhere in between a 15 and a 30, and then also you're paying 10 years less than if you were to just pay on a 30-year mortgage, okay? And then as we mentioned, you can always weigh refinance options, but again, none of us have a crystal ball. Okay, we don't know what the 10-year treasury yield is gonna be, and that's what typically dictates mortgage rates, mortgage prices, if you will, the cost of capital. So if you like this video, check out the screenshots from my home affordability spreadsheet. You can actually get that spreadsheet. It's down in the description below and also in the pinned comment. It took me a lot of time and effort to create that, and what it does is it actually weighs what your actual net income is versus the total cost of housing. So it's not just some, BS arbitrary, oh, take your gross income and it's 2.5x and blah, 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 blah. No, it takes your actual net income and it takes into consideration the cost of everything. HOA, property taxes, the principal, interest, utilities, all that stuff. So you can figure out, hey, can I really afford this house or am I gonna be house poor? And then you can always mess with the interest rates, the term length, the cost of the house, all those key variables. So please like the video, subscribe, hit the bell with notifications, send this video to a friend who may be in the market for a home. And again, check out the home affordability spreadsheet down below. Thank you so much and have a prosperous day.